Hi, I'm Patu from freefincal. Today, let's talk about which mutual fund should be used for 3 to 5 year financial goals. Some of you might say that the answer is obvious. You just use something like a liquid fund or something like a money market fund and so on. But we're going to discuss in this video why that is the case, and in particular, we're going to talk about more than what mutual funds to choose, mutual fund categories to choose. We're going to talk about what mutual fund categories to avoid and why to avoid them. Obviously, any kind of aggressive hybrid funds or direct equity funds should be avoided for 3 to 5 years, simply because if there is a loss, there will be loss in value or time. There simply will not be enough time for you to recover from that loss. So the asset allocation that you use for a 3 to 5 year goal should be 100% fixed income, 100% debt. There's no problem there. And although there will be some small impact due to inflation, beating inflation should not be the goal for 3 to 5 years. That's simply not necessary. Because it's too risky. Then you have to take on risk, and that can backfire. So leave alone inflation for short-term goals. Don't worry too much about tax. You can say, why do I even need mutual funds? I can just simply stick to recurring deposits and fixed deposits. That's absolutely fine too. So we're going to talk primarily about safety. Even people who are capable of understanding mutual funds, mutual fund risk and reward balance and so on, even they should put safety as the first priority. Now, the data I'm going to source from this is from the monthly debt mutual fund screener, the May 2021 version. You can find the screener in the website. And before we begin, many financial advisors make this mistake of saying, if you have a 3-year goal, buy a mutual fund whose average maturity portfolio maturity tenure is 3 years. If you have a 5-year goal, make it average maturity can be 5 years. This is absolute garbage advice. I have talked about this before. It's extremely volatile, usually extremely risky to do that. If your investment tenure is 3 years, then the average portfolio maturity period of your debt fund should be much less than 3 years, 1 year or 0.5 years, something like that. At least not more than 1 year. That's the kind of thumb rule you should have. It should be much less than the investment tenure. Now, so the for typical investors who don't have the time or inclination to dig deeper, the only categories that have a very narrow investment profile. That means typically all the funds in the category will have good credit rating or the same credit rating, good credit rating, and also the tenure of the average maturity of the portfolio will not vary too much from one fund to another in the category. So these are overnight fund, liquid funds, and money market fund. Overnight fund is basically for corporate institutional investors. I think retail investors will not get any money. They will definitely not even beat an SB account, I think, at best. Many people are complaining that liquid funds are not beating SB account these days, but that's cyclic. That will happen. That's because the interest rates are low, then liquid funds also will not be able to perform. Eventually, at some point in time, interest rates will go up, and then liquid funds will start beating bank accounts, SB accounts. Fixed deposit may or may not be. That depends on it. Money market funds is something that what I would recommend for 3 to 5 years. Because you can get slightly better return than a liquid fund if there is no credit event and so on. Now, the mutual funds that should be avoided by all investors. Don't use any equity funds. Don't buy equity savings funds. That's absolute nonsense. Don't buy any kind of equity-oriented hybrid funds. That's also nonsense. Except arbitrage. Arbitrage also, I would say, only savvy investors, people who kind of can discern what is the nature of the fund, where the fund invests. Arbitrage fund can be used by them. There are something called low duration funds. These currently have an average maturity portfolio maturity of 0.5 to 2.7 years. And many funds in this category invest in AA rated bonds. So definitely there's a possibility of credit downgrade. Of course, that is there even if there's only AAA in the portfolio. But definitely there's too much variation in terms of average maturity, and I would avoid low duration funds. For the same reason, short duration funds should also be avoided. they have a portfolio maturity of 0.3. The range in the category is ranges, the average portfolio maturity ranges from 0.3 to 1.8 years. Again, I would avoid for the same reason. There's something called medium duration funds. Please avoid that also. Same reason. They have an average portfolio maturity of 3 to 4 years. And all of these invest in AA bonds as well. And so all other debt funds, of course, except liquid funds, overnight funds, and money market funds, all other debt funds please avoid. All other debt oriented hybrid funds also you can avoid. For the same reason, there will be too much of variations in average maturity. There will be also the possibility of credit risk. Those who can consider themselves as savvy investors, who can understand the portfolio, who can take some time to study the risks factors and the history of the mutual fund, ultra short duration funds can be used. These have an average portfolio maturity of 0.7 to 0.2 to 0.7 years. That's quite a bit of variation for ultra short. That's very sad, and they can also take on credit risk. Hybrid arbitrage funds, they are no longer arbitrage funds, they are hybrid arbitrage funds, because they can invest in bonds as well. They can be used, but you be careful while using them. The credit quality is important, because if the arbitrage opportunities dry up, then these funds can take on credit risks, so you have to be careful. Overall, if you look at it, I would say for 3 to 5 years, if you are scared of any other fund, stick to liquid funds. Otherwise, if you want to be a little more adventurous, you can go to money market funds. Beyond that, it's better to avoid all others for most investors.